Datavault AI, trading under the ticker symbol DVLT on the Nasdaq, closed its last trading session on Friday, May 22, 2026, at an exact price of 46.42 cents per share, marking a significant intraday surge of 11.13% with a trading volume that exploded to over 57.1 million shares. Today is Monday, May 25, 2026, and because the U.S. stock markets are completely closed for the Memorial Day federal holiday, there is no live intraday movement happening right now, giving us the perfect quiet window to look at what is actually going on behind this massive volatility. Now, the obvious headline here is that double-digit single-day gain, but the deeper development that most retail traders completely missed on the retail investing sites over the weekend is that this microcap tech stock just structured a massive $4 billion joint venture called Goldmine AI alongside Wellgistics Health. While casual observers on standard mobile platforms are looking at this purely as a cheap penny stock ride, institutional algorithms are silently evaluating whether this single partnership can actually backstop the company's seemingly absurd management guidance of hitting $200 million in revenue for the full year of 2026. The baseline expectation across the retail trading space, from forums to basic watch lists, is that Datavault AI is simply another highly speculative, distressed asset that changed its identity from WISA Technologies back in early 2025 just to catch the broader technology hype cycle. On paper, it looks like a textbook trap because the stock is still down over 41% since the start of the year and has shed roughly half its value over the past 12 months, forcing many self-investing retail accounts to treat it with extreme suspicion. However, the reality hidden beneath the hood presents a fascinating contrarian puzzle because the underlying business has somehow managed to print a staggering 1,362% year-over-year revenue increase, climbing to over $39 million for the full fiscal year of 2025. This creates an intense psychological tension for anyone doing their online investing research, as they are forced to weigh the brutal reality of a capital-intensive business running a deeply negative earnings per share against a massive operational acceleration that peer groups in the semiconductor or software licensing sectors rarely match. When you look closely at the daily swings and the massive volume spike that carried the stock up past 46 cents on Friday, you begin to see how the market is actively trying to resolve this massive disconnect. The regular average daily trading volume for this stock typically hovers around 52 million shares, which means the 57 million shares that changed hands on the last session represents a major accumulation phase that pushed the asset up from an intraday low of 41.5 cents to a session high of 48.35 cents before settling near the top of its range. This intense liquidity expansion indicates that institutional blocks and sophisticated active trading accounts are using the volatile price action to build positions, likely reacting to the cash influx from large-scale corporate partners. For instance, the company recently locked in a massive $120 million financial contribution from Silex to explicitly fund their ongoing commercial expansion, which provides a massive cash runway that typical microcap tech firms simply do not have access to. Yet, despite this massive surge in short-term momentum, the broader sentiment across the major trading applications remains deeply fragmented. If you look at the wider analytical landscape across premium individual brokerage tools, the valuation models are all over the place, with some mathematical fair value models suggesting the stock could technically be valued closer to $4 if it successfully executes its enterprise licensing scaling, while traditional market multiples paint a much more grounded picture. Right now, the stock trades at a price-to-sales multiple of roughly 9.5 times, which actually places it at a slight premium relative to the traditional U.S. semiconductor average of 8.8 times, but leaves it at a distinct discount compared to premium software and data optimization peers. This strange mid-tier positioning is exactly why the options market and high-frequency trading systems are treating every minor press release like a major macroeconomic catalyst, swinging the stock through massive ranges that completely disregard the broader market stability. To truly understand why the stock behaves this way, we have to look closely at what this business actually does and how its underlying structure was assembled. Originally founded back in 2010 and widely recognized for years under its former name, WISA Technologies, the corporate entity underwent a complete structural pivot under the leadership of its chief executive officer, Nathaniel Bradley. The current operational footprint is split cleanly into two core operational divisions, focusing heavily on a unique mix of acoustic science and modern data science. The data science side of the house is built entirely around an enterprise suite of platforms including Datavault, DataValue, DataScore, and the Datavault Bank, which are engineered to provide high-performance computing solutions that allow large enterprises to securely measure, audit, value, and ultimately monetize their proprietary data assets within modern digital environments. On the flip side, their legacy acoustic science division remains highly relevant, anchoring industry-standard protocols for high-definition, multi-channel wireless audio transmission that solve complex issues like data timing, spatial synchronization, and wireless interference cancellation across millions of consumer electronics worldwide.
When you look at their historical performance, the business used to struggle immensely with stagnant technology licensing cycles, but the pivot toward data valuation completely flipped their growth trajectory, as evidenced by their recently reported first quarter earnings for 2026, which brought in $3.42 million in quarterly revenue. However, the legacy cost structures of managing a global engineering footprint of nearly 200 employees across major hubs like Beaverton, Oregon, means that their net income remains deeply negative, posting an earnings per share of -96 over the trailing 12 months, which continues to scare away traditional conservative value investors who rely purely on positive cash flow metrics. Looking forward, the absolute core catalyst that will determine whether Datavault AI survives as a high-growth tech titan or collapses back to its microcap origins is their ability to bridge the massive gap between their current financial reality and their forecasted milestones. Management has repeatedly doubled down on an incredibly bold full-year revenue projection of $200 million, a milestone that requires them to sustain an absolute vertical growth curve through their fresh blockchain-powered healthcare ventures and data monetization frameworks. If the company hits those numbers, the current 46-cent share price will look like an absurd historical anomaly, but if they miss, or if the gross margins compress even further under the weight of aggressive software deployment costs, the market will likely penalize the stock severely, sending it back down towards its 52-week low of 25 cents. Comment below how many shares of Datavault AI you currently hold, or if you are completely bleeding microcap tech right now. It is incredibly valuable to see how the broader community is navigating these massive risk-reward profiles in the current high-rate environment. Ultimately, this entire investment thesis boils down to an ongoing battle between traditional structural skepticism and unprecedented operational acceleration. The market expectation dictates that a company trading under 50 cents with an unprofitable history is inherently dangerous and prone to continuous structural dilution, which is exactly why the stock has faced such heavy short-selling pressure throughout the past year. But the reality is that the underlying revenue metrics, the deep institutional partnerships, and the sudden influx of structural capital suggest that Datavault AI is operating on a completely different level than its historical performance would indicate. Whether you view it as a highly speculative trading vehicle or a deeply undervalued infrastructure play, one thing is completely undeniable. The immense tension between what the general public believes about this stock and what the hard data is starting to show makes it one of the most compelling and high-stakes situations in the entire technology sector today. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, subscribe for more updates.